Hello, friends. Tony Warfield here. Thank you so much for taking the time out to sit down with me and participating in this discussion. Over the past couple of weeks, we have had some great conversations and we got a chance to discuss compound and simple interest, lightly. But I wanted to be able to go a little bit more in depth in helping people to understand exactly the different types of interest that are out there that affect our money. Today's discussion is going to be how interest affects you. So let's go ahead and get started. As always, I definitely appreciate any comments or any questions that you might have. So if you're looking at this on YouTube or social media, feel free to put your questions and comments in the comment section, and I definitely will get back to you as soon as I possibly can. And you will not be seeing my face on this video as much as I'd like to be able to show you who you're talking to or who's talking to you, but the information I felt is important that you be able to see it and reference it, screenshot, rewind, do whatever you want. So it's in text form to help you get a better understanding of the information I'm trying to convey. So the different types of interest that are available, your simple interest, which represents the most basic type. Compound rates change or charge interest on the principal and on the previously earned interest. Amortized rates, common in car and home loans, are calculated so borrowers pay a larger amount of interest and a smaller amount of principal at the start of the loan. Now, simple, compound, and amortized, those are the three that I really want to focus on in this conversation, but I also wanted to share a few more. Fixed interest rates stay the same over the life of the loan. Variable interest rates change depending on the underlying interest rate, usually the current index value. Prime rates refer to the interest rate that commercial lenders use with their best and most credit-worthy customers. Now, so many of you know how much I've been harping on making sure as a community we do better with our credit. So this is one of the primary reasons. You save a lot of money when you get those lower interest rates. And then there's discount rates. When the Federal Reserve Bank makes a short-term loan to a financial institution, they apply an interest rate known as discount. So let's take a look at it, simple interest first. Simple interest is paid only on the principal. If you look at the chart to the right, your principal in blue remains the same over the course of the 10-year period in this particular example. And as each year goes by, you get 10% added to your principal, 10% added to your principal, 10% added to your principal every year. So that's an additional $100 every year. So after 10 years has gone by, you've earned $1,000. Added to your principal, you now have $2,000 in your account. So what does this mean? If you borrowed the $1,000, you would owe $2,000 at the end of the 10 years. If someone borrowed it from you, they would owe you $2,000 at the end of the 10 years. And if you had an asset like a bond, it would be worth $2,000 at the end of the 10 years. Pretty simple, slow growth. It actually benefits you depending on if you're paying versus if someone's paying you. So take a look at that. And then, of course, there's compound. Compound interest. There are rates that charge interest on the principal and on previously earned interest. So what does that mean? So if you have an account, just like you did with the simple interest with $1,000, 10% added to that account, and you didn't put any more money in that account over the course of the years. Your account will mature after 10 years or however you have it set up. And then after that 10-year period, you'll have about $2,500. That's $500 more than you would have had with simple interest because the interest is compounding every year as opposed to just being added, the same rate being added to the same principal. So what happens is your principal has interest added for this year, and once that interest is added, that interest plus that principal becomes the principal for the following year. So if you look over at the chart to the right, you can see that your contributions are the same, but your total future value continues to increase over the course of 10 years, up to $2,500. Now, let's say that you decided you wanted to let's say you decided you wanted to go ahead and add some payments, monthly payments to your account every month. Let's take a look at that. So your same $1,000 you started out with, but your monthly payment being $100, plus the 10% that's compounding annually over the course of 10 years, as instead of $2,500, you have $21,000. Your contribution over that time would have been $13,000, which would have an additional $8,000 added to that because the interest was compounding. Now, this is actually pretty simple, and numbers are perfect. I understand that, but to help you understand how that works, take a look at the graph again, and you can see that as you continue to contribute your money continues to grow with the added interest that's going into your account. I think that's fantastic. So next, we're going to have your amortization rate. Now, amortized rates common in car and home loans are calculated so borrowers pay a larger amount of interest and a smaller amount of principal at the start of the loan. As time passes, the amount of principal paid each time increases, shrinking the principal and therefore the amount of interest charged on it. Thus, the amount of interest charged on the principal decreases over time while the interest rate stays the same. Now, this is for your car loan, this is for your home loan. And when you get your loan, I'm pretty sure they give you like an illustration or something that shows you exactly your payment schedules. So let's take a look at one of those. Say you wanted to go ahead and buy yourself a house, and unfortunately, most people, they're getting the 30-year mortgages, which is far more advantageous to the bank than it is to the consumer, and you'll see why shortly. So if you have a 4% rate, your credit's pretty good, and right now, what is it, the end of 2019, the federal interest rate is around 4%. So you get a home loan for about $250,000 for a period of 360 months or 30 years. So without insurance or anything like that, just a basic payment, you're looking at about $1,200. And as you can see on the chart, your principal is about 360, but your interest is over 800 bucks. And you can see as you go to February, March, and on and on and on, your interest rate decreases and your principal increases. Now, it's not until like 15 years later to where they actually balance. You have just as much interest or just as much principal coming out of your payment. But you can imagine that by the time you get to the year 30, yes, of course, if you look over there on the right side, the majority of your payment is going to your principal payment. That's because all your interest has already been paid to the banks. Now, they want their money. They want their money up front. You're paying them for the use of their money, and you're paying dearly, because if you look at the bottom right side there, after the 30-year period, you're looking at about $179,000 in this case. That's almost the same amount of money that you borrowed. Now, that's at 4%. Now, you could possibly get that better depending on what the federal interest rate is at the time that you purchase your home. I've heard of people getting as low as 2% loans and even better than that. But what happens when you don't get better than that? What happens if your credit is not up to par, but you got to get a house, because rent is crazy. I'm not gonna lie with you, it's crazy. So you want to go ahead and get yourself a house, but your credit is not so great, and you end up getting quoted with an interest rate of 6%. You're still looking at that $250,000 loan for the same loan period, but now your payments are $1,500. And just like with the other payments, you're looking at the majority of it going to interest in the beginning, and at the end they've already got their interest. But this time, instead of it just being just under the amount that you borrowed, it's way over. You're looking at an additional $289,000 that you've paid in interest. So it's financially advantageous to you to, one, make sure you have your credit right, because you pay infinitely less. That money can be going to your kids' college fund or funding some other projects for you, for your family, or hey, it could even go into another interest-bearing account that's going to help you have a better retirement. That money can definitely be better served. Now, the way that the laws are changing, the tax laws are changing right now, a lot of that money might still be able to be deducted from your overall annual income. But the way things have been changing lately, you want to make sure you're doing the best that you can with your interest rates. So if that does change, you don't get impacted so adversely like that $289,000. And this is only on a loan for $250,000. What happens if you're looking at a house for $500,000 or more? So you believe me, that number is going to jump up significantly. So definitely take a look at that. If I'm not a realtor, so if you have a realtor or someone that is a loan specialist, you definitely want to contact them so you can get this understood before you start shopping around for a house, because you might want to do a cost comparison. Right now, you're not making any money, or you don't get to deduct your rent payments or anything like that. But if you're looking at, say, your rent is $1,500 and you're looking at a mortgage of $2,500 plus mortgage insurance, depending on how much money you put on the down payment, this could make a big deal. You might want to go ahead and wait another 3, 4, 5, 6 months till you get your FICO score better, so you can get closer to the 4% rather than the 6%. Because as you can see in these illustrations, it can make the difference between you paying $179,000 or $289,000, $120,000 difference. I think that's worth waiting a couple of months to make sure your FICO score is okay, but that's just the thought. So let's move on. So fixed interest rates, they stay the same over time. Often used in mortgage or long-term loans, fixed rates are predetermined. Borrowers benefit from a fixed interest rate because they know that it won't rise. The loan payment then remains the same, making it easier to include in the family budget. Now, that's for payments, but what happens when you're investing? So if you're someone who's not really into a whole lot of volatility, fixed rates are for you. I mean, you know what it's going to be, but the only problem is you want to make sure your fixed rate is keeping pace with inflation, because if it's not, you're losing money. Just if you have a savings account, you're getting what, 0.1% overall out of that? Yeah, you're losing money hand over fist. And if you look at the earlier illustration, correction, if you look at the earlier example, you got $1,000 in your savings account earning 0.1%. Inflation's going up. Let's say it's a great year and it's only going up by 2%. You're still losing 1.9% on your money. So we want to definitely put you in a better financial situation with finding a better product that's going to take care of you. And that's another discussion that we can have one-on-one. We also have, let me go ahead and hit that. Variable interest. Variable interest rates change depending on the underlying interest rate, usually the current index value. Commonly used, the current indexes include the cost of savings index and the 11th district cost or fund index. Funds, I can't get this out to save my life. I'm sorry, everyone. Variable interest rates are used on loans such as adjustable rate mortgages or ARMs. Variable interest rates usually change weekly or monthly and can increase or decrease. So unlike with the fixed rate, somebody that they want to be able to take advantage of some of the large growth opportunities that you have in different types of investments or different types of financial products. They're less likely to be fearful of the amount of risk. Usually someone, a younger person might want to do that, 20s or 30s. But as you get older, you want to have less of that risk, because, hey, you don't want to take the chance of the market dipping, which it will, because it takes so long for you to recover from that. So you definitely want to be able to take a look at what benefits you the most, the fixed interest rate depending on where you are in your life, or the variable interest also depending on where you are in your life. So you have the prime interest rate, refers to the interest rate that commercial lenders use with their best and most creditworthy customers. This rate is based on the federal funds rate, or a daily rate that banks use when they borrow or lend funds with each other. Though large corporations are normally the recipient of prime rate loans, the prime rate affects consumers as well. Personal, mortgage, and small business loan interest rates are influenced by the prime rate. Now, what does that mean? So, have you ever seen those commercials? It's usually car commercials when you hear it. 0.9% financing for well-qualified customers. You've heard them say that before. This is what they're talking about, right? So in order for you to be able to participate in that, you got to have a very, very, very good credit history. It doesn't have to be perfect, but you're not going to be able to get, those 0.9% interest rates if you're looking at a 680 FICO score. You need to be, upwards of 759 and above, possibly even 800s, depending on which financial organization that you're trying to get a loan from or buy a car from. Regardless of whatever it is, you definitely want to make sure your credit is in a position that you can maximize your position. Then, of course, finally, there's discount rates. Now, admittedly, I don't know anything about this. I don't do anything with the discounts rates because mainly it doesn't affect the common consumer. When the Federal Reserve Bank makes a short-term loan to a financial institution, they apply an interest rate known as a discount. Discount rates are based on cash flow analysis, which takes both the time, value of money, and the risk of future cash flow projections into account. Yeah, that's a whole lot of information that I really don't know a whole lot about. But if you have any questions about it, believe me, I'll figure it out if you have any questions on that. So I hope this helps. These types of interest rates, they definitely affect how you spend your money. And if you better understand which ones you're using or which ones are affecting you, you can better manage your finances for your household. I'm all about us growing as a community financially. So these videos I hope will help you gain more knowledge and be able to share more knowledge with the people around you. That being said, if you have any questions or comments, please contact me directly. You can call me at my phone number there, or you can call me at or you can send me an email, leave a comment in the comment sections, whether I be in social media or whether I be here on a YouTube video. And once again, thank you so much for your time. I appreciate you, and God bless.